Hello all, I'm Shlomo Cooper and this is a new week for us. That means a new session for the Investors Club just before the wheeling of Wall Street are starting to rock and roll. So before starting our session, just for all the new guys here, what is the Investors Club that we are that we are running each and every week? So if you have an interest in the investment world or simply want to get unmediated professional insight into attractive and high quality Wall Street investments, you have the world to gain from TradeNet's Investors Club. Our Investors Club was created to help our large client base achieve their long-term financial goals. My name is Shlomo Cooper. I'm a senior TradeNet analyst, accomplished trader, and Wall Street investor. At the start of each week, I will guide you as we embark on a wonderful and fascinating journey into the investment world. Together, our financial opportunities will become one and the same as I expose you to an investment approach that will put you on the right side of the map with the market winners. Whether you are a day trader, swing trader, or maybe long-term investor, and most probably part of each, your thirst will be quenched by the new investment opportunities that I place at your fingertips. So if it's your first time in the Investors Club, welcome on board and welcome to the Investors Club. With another week in the books, it's time to take a look at what might be making news this week, and it's going to be a very, very exciting week. But before that, just let's take a look on our map just to see what happened last week. So a lot of green across the board with the S&P, the Nasdaq, QQQ, and the Russell 2000, the IWM. They are all in green, ending the week with sharp gains, especially the Nasdaq, who actually jumped to all new time highs. And right now, year to date, it has gains of more than 7%. Also, it was a good week for the biotechnology. We are tracking here the ETF IBB, which was up more than 2% since last week, and that means year to date it's approaching 20%. That is a marvelous performance for this group. Looking on the USO, which tracks the oil made a little bit of a pullback last week, but still, months to date, it has a great performance with almost 17% of gains. This coming week, Apple is set to serve as one of the market's catalysts as it releases its Q1 financial results after closing today on a Monday, and we are going in a couple of minutes to actually open the books and see what Apple needs to deliver in order for its stock to go up. Earnings report this coming week will include a number of big names in the energy sector, like ExxonMobil XOM on Thursday, and the CVX, which is a Chevron, on a Friday, and they are going to leave investors tense. Also, this coming week, Wall Street is primed and ready for hints as to the timing of its interest rate hike, with the Federal Reserve releasing its interest rate policy statement on Wednesday afternoon at the end of its two-day meeting starting on Tuesday. The central no freeze right now, because the central bank has already ruled out the month of April as its first rate hike, and as such, not much in the way of novelty is expected from this announcement. Let's go and start with the Nasdaq, and let's see how the Nasdaq performed last week. That was one of the most exciting place to be in. All right, so here we see the Nasdaq Composite, and it finally did it. After 15 years, the Nasdaq Composite has hit a new all-time high, and in doing so, it's blown by the developing head and shoulders pattern that had us concerned a couple of weeks ago. And here we see the drawing of the high and shoulders, the head and shoulders. This is the head, the left shoulder, the right shoulder, although it didn't materialize. And by the way, we pointed out last week that as long as a pattern is not completed, it's just a potential. So that was just, a warning sign for us. Only if this only if this index is going down below the 4,800 points, but it didn't make it. Actually, it didn't make it. Actually, it went up, and when it went up, actually, it neutralized the significance of this bearish reversal pattern. Other US indices are also trending well, and basic technicals point to further upside despite nervousness over all sorts of economic data misses. Um, on Friday, we saw Google went up. We saw Amazon fly away. We also saw it was Starbucks gaining more than 5%. So, one of the most interesting questions to ask always is not just how much money did we make in this hot market, but how much money did the billionaires in the market make last week. So if investors are celebrating new highs in the Nasdaq, big tech stocks are on fire. Nasdaq investors are celebrating, and how much money the billionaires were able to make in the last week. And let me tell you upfront that the biggest wins are going to the tech tycoons leading these companies. Jeffrey Bezos, he's the CEO. We see him here on the picture right now. He's the CEO of Amazon.com, has plenty to smile and laugh about. His stake in the electronic commerce company is up $5.8 billion this last week, a remarkable boost in his wealth. And let's just take a look on Amazon stock. This is Amazon gapped up on Friday and actually is completing nearly 90% gains for the week, ending the week just shy of $446 level, coming off the company's quarterly profit. So if you are asking, business own nearly 84 million shares, and he's at the top of the billionaires list here. Amazon with gains of $5.8 billion for 1 week. Not bad, but it was a good week, also a good day on Friday for former Microsoft CEO Steve Ballmer. He's on the second row here, and Ballmer owns according to Microsoft's latest proxy statement, Ballmer owns more than 333 million shares of Microsoft, and thanks to Microsoft, and let's put Microsoft on the chart MSFT. Thanks to Microsoft's better than expected first quarter, the stock is up 15% in a week, almost 14% on 1 day. That was on Friday. A great gap and go. Look on the volume that spiked up, and that means it's all translating to a boost of more than $2 billion for Barner, the CEO. By the way, co-founder Bill Gates, he doesn't own as many shares as Barner. He has only less than 240 million shares, and that is because he's been selling selling some shares to raise money for charity, and he's spending a lot of time for all his charity activities. Even even so, he's still up 1.5 billion dollars at the he's at the bottom of the list. So he's still richer coming off this week. Google guys aren't doing too shabby either. Let's put here Google on the chart, GOOGL, and the shares of Google are up 8% this week after a sharp rise on Friday, even though the company missed revenue and profit forecasts. That makes a gain on the week of $1.8 billion for co-founders Larry Page and Sergey Brin. Let's see what happened on the S&P 500 chart, and I'll put here the SPY, so we will see the ETF that tracks the S&P 500. The S&P 500 just barely was able to make a new all-time intraday and closing high on Friday. But that said, one positive thing that happened last week is the all right, and I'll take here the downtrend line, is that the downtrend that has been developing over the past 2 months is now broken, as we can see on the chart, and there is support below these levels, and as we can see, we are going to stretch a line from the bottom of this year, near February, together with the bottom of March and early April, and right now this uptrend is going to supply another support zone for the market should the S&P 500 will go to a profit-taking phase. Also, looking on the chart, we have here a very solid support around 204 on the SPY. Taking a deeper look on the 30 minutes time frame, and this is a time frame I strongly suggest for any day trader here in the room to watch and to track as the week go on. This is the 30 minutes on the SPY, starting here on Monday. So on Monday we had a great start for the week with a gap up. Actually, it was for the week a gap and go, because the market didn't look behind after it embarked with these sharp gains on Monday. It did make a little bit of a pullback on Tuesday back to the rising 5 days moving average, and and the 5 days moving average is the best indicator to have on the 30 minutes chart, because it gives me a very clear and quick signal to what to expect from the market in the immediate term. All right, so as long as we see the market goes down to the rising 30 minutes, to the rising 5 days moving average, this is a support zone, and this is what I'm saying all the time. The market above this average is innocent till prove otherwise, till prove guilty. So as long as the market getting support here, we need to initiate long positions, and from there there is a great bounce to almost to new all-time highs. Now getting to this week, we can put a support around 210. This was just the low of Thursday action, and another support zone just below 209. That was the low of Monday as well as Wednesday, and just see that if the just watch that if the market is deciding to take a little bit of profit taking this week also, and is breaking down the support level, he's also may be able to find a support around 208. This is the closure of the gap, so all of this zone is a gap, and lots of time we see the market going down to check the gap, maybe to close the gap before it can go higher. Most of all, the immediate action that we're going to see on Monday, I want to check this rising 5 days moving average, and probably the most positive action we can see is a little bit of a pullback back to around 210.5, just to check to test this rising 5 days moving average, and maybe if we have a decent reversal here, this will be the first trading opportunity for this week. Moving forward to the Russell 2000, the IWM, and I'll put the IWM on the chart. And by the way, I got lots of questions how to put the 5 days moving average on the 30 minutes chart. So it's very, very easy. Just choose a moving average of 65. So if you choose the interval of 65 on the a 30 minutes time frame, you'll actually get the 5 days moving average from the daily chart. Now going to the IWM, the ETF that tracks the Russell 2000, and I'll put here the daily chart. So just take the template for the daily, so I'll have the all moving average correctly, and on every daily and weekly chart I have the 20, the 50, and the 200 EMA, exponential moving average, and also here it's look pretty good too. The Russell 2000 of small caps is trending well to the upside, and although it has given up some outperformance over the past few weeks and did not hit a new all-time high with the large caps, it's still looking quite attractive on technical basis, as the strong dollar weighs less on domestic focused small caps than many of the reporting companies in the large cap indices. And this was one of the biggest issues for the market, how the strong dollar is going to weigh and is going to affect all the reports that are coming right now in the earnings season. Right now we can see that the uptrend is still supporting the IWM, and it has a solid this is a solid uptrend, and maybe the best thing to look here, and I'll just maybe the best thing to look here is the zone of 200 and this is the SPY, sorry about that. All right, this is the IWM. All right, so again, this is the uptrend. Okay, and the best thing to look here is the 50 days moving average. This is the green line on my chart. It's right now rising, and it offered a great support for the IWM both twice in the past, both on March and at the beginning of March and at the end of March. So this is the first point I want to see if the IWM can get another support here. So it's a good picture also for the small caps. Let's go to the earnings, and shares of Apple finished. All right, let's put Apple on the chart. Apple finished Friday's regular session higher by 0.5% to just below $131, ahead of the tech titans' latest quarterly financial results. It's scheduled to be released today, Monday, after market close, and for second quarter, Wall Street expects earnings of $2.16 per share on revenue of $56.1 billion. these are huge numbers. Now, I'm watching Apple earnings for Apple Watch orders, updates on Apple Pay, as well as Apple TV and the iPhone, which I think will post remarkable results. Here's the key thing about Apple. It's still a very low multiple stock. All right, although it just climbed more than 15% since the start of the year, and on the weekly chart, it's just one of the best, financial opportunities in the market history. But Apple is a stock that we just need to watch it, to track it. This is the weekly chart, and as you can see from time to time, we have here a pullback, and we need to actually consider every pullback to take the cash out of our wallet and to put it on Apple, because it's just climbing and climbing and climbing, and this was a great story for the market in the past years. Now, so because it's still so cheap, after it went up so much, it's still, and after going so much higher, it's still a very low multiple stock. That is why I stay drawn to it. On Friday, the company officially launched the Apple Watch. Roughly 1 million customers pre-ordering the smartwatch on Friday alone. And on average, customers ordered more than one watch. Actually, it was 1.3 watches per customer, and on average, they were spending more than $503 per watch. Roughly 62% of the buyers purchased the less expensive sport model. So I'm encouraged by the initial demand and believe the watch will quickly become embedded within Apple's already robust ecosystem. Given Apple's powerful iPhone cycle, the momentum we see around the iPhone in China, and the launch of the Apple Watch now on Friday, I believe there is still plenty to look forward to, a lot to look forward to at Apple during this cycle. At the same time, I believe Apple's valuation has room to expand from depressed levels, and this is why I put my target at $160, and I'm going to buy Apple ahead of earnings today. That means a couple of minutes before the end of today's session, Monday's session, I'm going to buy some Apple for the earnings. One of the biggest dilemma for any investor, and this dilemma went up front last week, is what to do when a stock or an index is making a new all-time highs. Is it a good time to enter? Maybe it's the time to ring the register and run away. So with Nasdaq at new closing highs, I've heard plenty of talk about the bubble nature of large cap tech these days. And if you just watch the biotech, let's put here the IBB that tracks the biotech, that was one of the best performance in recent years. And there are a lot of investors that are saying right now this sector has went too high within a very short time, and this is a bubble nature of this is a bubble action. And while there are legitimate arguments to be had about the substantially of growth and valuation throughout tech, all-time highs alone are not a very good reason to short the Nasdaq. Now, the perfect example can be found in the S&P 500's response to breaking its 2007 highs. bears that tried to gear up for a repeat of the mid 2000s bull market and got got absolutely hosed as the S&P 500 has simply ripped from the breakout to new all-time highs, and actually it printed a series of new all-time highs. Sometimes bull markets end near previous all-time highs, but usually they don't, and there is usually more going on than just a new high watermark for the index. So you can't just say, all right, I'm going to short the market here because it reached new time highs. I'll tell you more than that. About 50% of the time in the long market history, the market is at or near all-time new highs. So if you are not willing to put money to work around all new time, all new around new all-time highs, that means you are going to miss a lot of great opportunities. This is just the mechanics of the market and the dynamics of the appreciation of the price in the market. With the Nasdaq already up nearly 7% this year, though, there is a feeling that maybe the index has gotten ahead of itself. Now, why 7% is an impressive gain, I'm going to surprise you because there has only been 1 year since the bull market began, including 2009, that where the Nasdaq was not up at least 4.5% through the 23rd of April. So the type of gain we have seen so far this year for the Nasdaq, and let's put here again the Nasdaq index. I'll put here comp with dollar sign, all right, a great rise. Again, I'm on the weekly chart, but the gains it was able to achieve since the start of the year is the type of gain we have is something that we have seen so far is more normal than abnormal. All right. Let's go on, and I want today to focus on a strategy that I think is one of the best long-term strategies. Each one of you can implement it, very easy to implement, with a lot of knowledge and a lot of wisdom embedded into it. Now, the Nasdaq Composite Index hit an all-time high on Thursday morning, and I wanted to take a look at how a certain type of long-run investor would have done buying that index. In celebration of the Nasdaq's new record, I want us to consider an investment strategy for someone investing in the technology-heavy index. How an investor would have done following a strategy by putting $50 per month into Nasdaq index fund, let's say the QQQ that tracks the Nasdaq index, every month since the index's pre-crisis high in March 2000. So I'm going to, to put a terrible timing for making such a saving, putting our investor at the top of the barrel. First of all, here's how the Nasdaq has performed at the end of each month. So this is a monthly chart of the Nasdaq since the dot-com bubble peak in March 2000. First of all, we see here the big crash running for the first couple of years of the 21st century, followed by a very slow rise until the financial crisis at 2007, which saw another crash before the more recent post-crisis upward tier. Now, we are going to consider a hypothetical investor who puts $50 at the end of every month into the Nasdaq index fund, starting in March 2000 and continuing to the present. All right, each month, at the end of each month, is going to put $50. Is going to buy a $50 worth. $50 is going to buy a $50 worth of QQQ. All right. So he puts this $50 in every month, no matter what happens to the index. Here is our investor's price return. Let's look at it. Less his $50 per month cost. So this is only the profits he was able to accomplish using this strategy. So actually our investor starts out having a couple of rough years while the dot-com bubble was bursting. He then saw some gains that were taken out completely where the financial crisis took place. But despite that, in the last few years, things have been looking very good for him. The value of our investors' portfolio is about $19,390 at the end of March 2015, and he has invested a total of $9,050 since 2000. This gives him a huge 114% return on that investment, which works out to a healthy of 5.2% annual return. This is, of course, remarkable figures, considering that our investors started buying the Nasdaq at the height of the tech bubble, probably one of the worst timing combinations in the history of capitalism. I often encourage young people to start saving early for their retirements. And you know, at the end of the road, each one of us will need to retire. And we don't. And usually, you know, around the world, it's very, very common that men retire around the age of 65 in the United States, or 67 around Europe, but you don't have to. And one of the most effective ways for a long-term investor to go about making their investments is dollar cost averaging. The concept behind dollar cost averaging is simple, and please don't confuse the investment strategy of dollar cost averaging with what part of traders may do in short term when they are averaging their cost when they are on the wrong trade. So these are totally different concepts, and right now I'm focusing on the dollar averaging cost for a long-term investment strategy. So what does it mean is that simply invest a fixed amount of money once every fixed time period, like each month or each year, no matter whether the market is going up, whether it's going down, or maybe it's just going sideways, it's flat. By doing this, you wind up buying fewer shares of your chosen asset when it's expensive, and you have much more money or much more shares to buy when it's cheaper. And this is why you are using a fixed amount of dollars to buy at each fixed time period. Keeping a steady hand at the wheel is such a boon to a long-term investor that dollar cost averaging. And even when starting at the absolute top of the bubble, as our hypothetical investor did, it led our investor to healthy returns in the long run. And of course, you can implement this investment strategy not only on an index like the Nasdaq or the S&P 500, you can also implement it on your favorite stock, like buying Apple or buying, a basket of favorite stocks. Okay, so talking about going back going back to the Nasdaq and just back to our last discussion, and to show you how the Nasdaq how come the 7% gain since the start of the year to date is actually one of the more normal market behavior. I wanted to show you this slide. And I want you to, and here we are actually going back to 1972, which was the Nasdaq's first full year, and there have now been 24 years since 1972, where the Nasdaq was up 5% or more year to date through the 23rd of April. In other words, the type of gain we have seen so far this year is more normal than abnormal. So what can we expect now that we have already seen a gain of 7%? So the table lists here each year that the Nasdaq was up 5% or more year to date through the 23rd of April. For each year, we have also included the index's performance for the remainder of the year. Also, we have here the max decline. So just bear in mind that most often than not, we do see a decline, we do see a pullback, we do see a phase of profit taking after the initial pop of the market in the first quarter of the year. All right, so, and probably most often than not, on average, as you can see, on average here, the max decline from the 23rd of April is a little bit less than 8%. So, if the Nasdaq is going down, will go on a profit-taking phase of 5% to 8%, this is especially going to be a good opportunity to initiate a long position on the market to buy on the dips. And buying on the dips was one of the best strategies for investors in past years. Now, looking on what happens rest of the year, including the declines here, on average, the market is going up 8.7%. All right, but the 8.7% is coming with positive returns at almost 74% of the time. These are very, very solid figures. These are solid figures that I like as investors. So definitely we are still on the running lane, and we are still taking our eyes up and need to look on the composite as an index that can actually go further and go higher till the end of the year. And that means buy any dip, and we are just going, so if I'm going to see a sell-off, I'm just going to embrace the sell-off, because it will give me a very good, another good opportunity to put money into action in the market. All right. Anyway, lots of investors right now looking on the Nasdaq at its peak right now, and they are saying, all right, maybe let's go and short the market, or let's short some stocks. So I want to show you how short figures may serve us as a good overlooking gauge for markets sentiment. Short interest figures for the end of March were released 2 weeks ago, And based on the performance of the most heavily shorted stocks, investors have certainly become more open to riskier names, even after all the declines we had 1 week ago. So the table here lists 41 stocks in the S&P 1,500. This is a larger index than the one that we usually talk about, the S&P 500. So this is times 3, this index. And each stock here has more than 25% of their free floating shares sold short as of the end of March. For each stock, we have also included its performance so far in April. And as shown, let's just go here down to the average. The average month to date return of the most heavily shorted stocks is a gain of more than 10%. All right, so this is something huge, and you know, and it's and by the way, it's much higher than the average of the S&P 1,500, which is it's actually barely flat. That means that another thing here is that among these names, the breathe was also being very strong, with 33 of the 41 stocks up on the month. Additionally, of the 33 stocks that are up, 14 have gained more than 10%. So performance among the most heavily shorted stocks is often a good gauge of sentiment in the market. If these stocks outperform, and as we can see, it outperforms substantially over the broad index, it is a sign that investors are willing to take on risk, and vice versa. When they decline, so based on this logic alone, investors are becoming a lot more open to risk, and this is good news to hear. One heavily shorted stock that has done extremely well this month, and let me just connect again. All right, here we come. All right, so one stock I want to show you is Shake Shack, S-H-A-K, and I'll just take off all the moving averages, so we'll see here a proportional chart, and this is the daily chart. All right, this is exactly what I wanted to show you. Shake Shack. Now this stock has 36% of its float sold short and is up over 25% in April alone. The bear case on Shack is that the stock is widely overvalued. Now, while I think you will have a hard time finding anyone who thinks the stock is cheap, high growth stocks are very cheap relative to the market. Another factor working in Shack's favor is that there is very little in the way of supply of the stock in the market. So when you couple that with the fact that it has a very loyal following, you get moves like the one we have seen in recent weeks, and this is you know, a short squeeze combined with a very short supply of stocks here, and Chuck is likely to be extremely volatile going forward, but it should reward investors in the long term. Another stock that I'm following, another stock that I'm already there, but by the way, above its IPO, it's actually a debut on earlier this year, around January. the end of January, I took it above the high of the first day. That means around 52, 57, and this is a great ride upwards. And looking forward, these stocks, the strongest stocks, give you more than one opportunity. So just put it on your wish list and put it out, this list, when you see blood in the street, when you see screens are screaming uh, rivers of red, rivers of blood. This is when you need to take your wish list, and to find on this wish list, Shake Shack is one of the components there, and then to try to get an entry into this great performance stock. Let's go to the economic scorecard, and as shown, it was on net another disappointment week for economic data relative to economics estimates of the data reported. Of the major indicators, the initial claims coming out each Thursday remain below 300,000. So, you know, although this is a disappointment and it went above the estimate, as long as it stays below the key number 300,000, this is a good figure. New home sales, another disappointment, but again, these are still near 7-year highs, and durable goods was one of the best economic figures this last week. What we are going to see next week, or actually this week. So this week is set up to be an absolutely ridiculous week in earnings. So it's not just about Apple. We have 892 names reporting, but there is also a wave of extremely important economic data as we show right now on the slide. So we are going to have the GDP for Q1 on Wednesday, all right, and also we have the FOMC on Wednesday, and we talked about it. We have two consumer confidence, one on Tuesday and the other one of the Michigan the Michigan confidence number on Friday to close the week. Also, we note some important figures on the personal spending and the personal spending, which is personal spending and the personal income. This comes to us on Thursday. So a lot to digest for us this weekend. Of course, a lot of catalysts for the market behavior. Let's see what happened so far in the earning season arena. And last week was the first big one for earnings, with roughly 400 companies reporting their Q1 figures. And 2 weeks ago, at this time, the earnings beat rate for this season was at 63.7%, whereas the revenue beat rate was way down at 42%. So just see what a good week did and how it actually changed all the figures. And as you can see, right now 66.5% of companies have beaten consensus analysts' earnings per share estimates so far this season, and this is a huge number so far compared to past quarters, and each bar here represents a quarter over the last years, and this is actually the biggest bar that we see here over the last 4 years. The revenue beat rate also ticked up big last week, jumping from 42% to 52.3%. And the early read this season was the bottom line numbers. They were strong, but top line numbers were severely lacking. Last week's reports generally came in strong on both accounts, and I think it's a big reason why the broad market indices did so well the past week. The strength we have seen in earnings has translated into higher stock prices for the companies that have reported. And and this is why there is a very strong connection between the numbers, the economic figures, that the financial figures that the companies report, and the behavior and the performance and the movement of their shares. And there is one reason why stock is moving up, down, or going sideways. It's not because of technical analysis, it's not because of the chart, it's because the stock at the end of the day is trying to reflect the value of the company. So far this season, the average stock that has reported has gained 0.71% on its earning reaction day. And for companies that report in the morning, its earning reaction day is that trading day. For companies that report after the close, we consider its earning reaction day as the following trading day. So as shown right now on the chart, the 0.71% is a very strong number compared to past quarters, and it's also better than the readings we have seen over the prior two earnings seasons, which were strong in their own right. So right now, let's move on and look at how stocks have performed on their earnings reaction days. And this is especially important information for day traders, all right? And this is why I'm showing you this, because most of us are also day traders. So here is a look at how stocks have performed on their earning reaction days based on whether they reported better than expected, worse than expected, or in line earning per share. So for companies that have beaten EPS estimates, the average stock, and these are the green bars, the average stock has opened, and this is the opening gap, has opened with a gap of 1.66% on its earning reaction day. It has been absolutely flat from the open to close, all right, appreciating in price only by 0.02%, and that means it closed a full day change, a full day of 1.69% up. So basically, all of the gains that stocks that have beaten EPS have seen have come in after hours or pre-market trading. For stocks that have reported inline EPS, these are the blue bars, the average name has opened with a gap down, lower by 0.09%, but then shot up 0.86% up from the open to close for a full day change of 0.78%. This means investors have been willing to buy stocks after the open of trading, even if they only reported inline earnings. And this is another gauge for us to estimate the the environment or the atmosphere that investors are living in. Finally, the stocks that have missed EPS estimates, these are the red bars here on the chart, they actually gapped lower at the opening by 2.35%, but once they have opened for trading, investors actually have beat them up by 0.19% from open to close of trading. So even for companies that have missed estimates, investors have been willing to buy on weakness, to buy the dips, and that means the worst stocks that missed the EPS ended the day with a decline of 2.18%, less than the picture on the opening. It's not just the US markets that are going up. We see also Asia. Asia is on fire. And from time to time, we want to take the focus out of the US market. We are still staying in the US market because we are going to use financial instruments that are existing in the US market in order to get an exposure to other interesting markets. Now, the biggest contributor to Asia's surge in recent weeks has been China. And we talked about China last week. Policy changes in China have incented massive retail participation during the surge higher in stocks. And just here the figures, 3.4 million new brokerage accounts were opened in last week alone. Now, here we can see the Shanghai composite for the last 6 months, and the FXI, and I'll just put here the FXI. The FXI is the chart that tracks the China market, the Shanghai 25 index. All right, so I just put here the FXI, so you'll see what a nice surge since it's broke out from a very long resistance, a long-term resistance line. Now, whether the surge continues is an open question, but I expect more excitement from China and from the Shanghai composite, and therefore from the FXI. You know, the only thing Western analysts calling for China's demise have been for the last 40 years is wrong. China has the world's largest population, has the strongest economy in the developed or developing world, and is well on its way to becoming the world's largest economy. These are conditions, these are processes that nobody can stop. So no matter what blind wearing Western analysts tell you, China is on fire. China, is a long-term theme, and this is something we need to understand, and we need to take it as another financial opportunity in the coming years. So of course, right now to buy the China or to buy the FXI will be foolish, but try to wait for any kind of a pullback, maybe back to to the rising 20 moving average, or even a sharper downwards movement towards the 50 moving average, in order to initiate a long position on the China or on China markets. Now, another opportunity looking on East Asia is something that probably no one of you has considered, and this is Taiwan. And Taiwan may very well be the Eastern Asia big surprise. One place to look in Asia for further gains could be Taiwan. And last week, the TAIEX index surged on news that not only would a connection between Singapore and Taipei be opened, but there is also a possibility that Taiwanese regulators could allow a Shanghai connection as well. As a result, Taiwan probed in a way similar to previous moves from Chinese indices, although in Taiwan it's just the beginning. It's the early moves. On Thursday, it was the third largest single day inflow from foreign investors since 2003 blasted in, and more is expected. While Taiwan is definitely not a certain bet, US investors looking to play the country should take a look at the ETF EWT, and the EWT is the ETF that tracks the Taiwan index. Let's put it here on the chart, EWT. Sorry for that, EWT. Now, AWT tracks the MSCI Taiwan index. As shown here, the ETF has surged over the past couple of days, but should Chinese regulator investors get full access to Taiwan, the upside could be much higher. It's worth noting that Taiwanese stocks are much cheaper than developed market alternatives on price to earnings ratios and price to sales basis as well. So this is another positive for the for Taiwan market. Another way to play China is by buying or trading shares of Chinese companies that are traded on US exchanges, and this is something that we are doing extensively here in the room. For example, it may be a SINA, SINA on the daily chart, and look what a nice pop-up, and it's about to go to a new high for 2015. So it has a very nice movement right now, a positive development on the chart. Also, I can mention a WB that is surging really nicely on the daily chart, and I was involved there making some day trading on Friday using a WB. Also, we can take a look on WUBA, WUBA, that has a consecutive of green days here on the chart, surging from $55 2 weeks ago to almost $8 last week, closing last week. And no, part of this great surge is not just what's going on around China, it's the short, the interest short, the heavy interest shorts in these Chinese stocks. So lots of short sellers need to, to throw the white towel to the arena, to put their hands up in the air and to say, all right, my mistake, I'm wrong, I need to let it go. All right, guys, we are getting to the end of the session. As always, you are more than welcome to send me emails, and I'll put my email here in the chat. So it's Shlomo at tradenet.com. You are more than welcome to send us suggestions, ideas, or if you have any sort of questions, you are more than welcome to send us. I wish every and each one of you a very successful week, and I'll see you again next week at the start of the week on Monday at 8 o'clock Eastern Time, when we have a new session for the Investors Club. Take care.